Hello, everybody, and welcome to this week's podcast for the week ending December 12th, 2025. Joseph, we're coming up on the end of the year. Doesn't it feel like 2025 has been quick?
It's been very fast.
Yeah.
I mean, most people don't know, but like I have a 1-year-old now, so and he just turned one like a month ago. So like this past year has been, talk about a blur. It's been
Yeah.
really a blur when you're sleepless for the first 6 months is pretty much.
And he's starting to walk and everything like that now,
Yeah,
right?
it's crazy. It's awesome.
Yeah.
It's awesome watching him, get bigger.
Yeah.
He's walking around now. He's trying to talk and everything. So it's been awesome.
And we're in the thick of wedding planning and everything like
Yeah.
that. So it's been a blur for a completely different reason, right?
I
It's just
remember
like
that. It's not.
no sleep, no money, no, you know what it is. But yeah, no, it's actually great. And again, coming up on the next couple of years, we'll probably discuss the the holiday season podcast schedule and everything like that in a later edition. But point is, busy start to kind of the end of 2025 yesterday, at that being Wednesday, what, the ninth?
Yeah.
Um,
10th.
we got the 10th, we got a rate cut decision. Joseph, why don't you talk about that, and then we can run into how that kind of changed the overall technical picture.
Yeah, so I mean, a month ago or so, we didn't have any government data. There was a lot of, is the Fed going to cut? Are they not going to cut? I mean, it was really pricing that they were going to do a 25 basis point cut, and then with the government shutdown, and
Right.
there was a lot of kind of hawkishness about, oh, we don't have enough
Yeah.
data to
How do
go
you even
off
know
of or
what to do,
whatever.
you know?
Yeah, so they did decide to cut um, 25 basis points yesterday, which going into the event, that was pretty much expected.
Right.
We did see kind of longer term or intermediate term rates tick higher. TNX actually gave a buy signal for the first time since May of this year
And now
and moved back to a positive trend.
let's talk about that for a second, because I think too that the first thing I thought was, I was like, okay, well, they're cutting rates, but rates further out are actually kind of increased. The reason for that would be what the overall kind of long-term expectation is, they might stick a little higher. Talk me through that.
Yeah, so right now, coming out yesterday, most of the FOMC committee had no rate cuts for next year.
Right.
They're expecting long-term rates to be roughly be the same, at least the Fed funds rate. And, in that scenario, and they kind of said like, oh, the economy's still doing pretty good. Labor market's cooling off. I think it's probably maybe a bit cooler than they think it is or what they're looking at. But, in that situation, long-term rates are going to stay roughly where they are. Inflation expectations are coming down, but are still around, 2 to 2.5% kind of on a longer term time frame.
Right.
So, 4.2% on the 10-year makes a decent amount of sense. And that's pretty much kind of, we've still been in this range since 2023. I mean, intermediate term rates have kind of bounced back and forth, but we've been in roughly that low to mid 4% range for a while now.
Now, you mentioned for TNX, right, going back to a buy signal and returning to a positive trend. Now, I don't have the chart in front of me. I think we broke a string of three sell signals there. And when was the last time we were in a positive trend on that chart, and what happened after that?
Yeah, so we moved back to a positive trend on TNX back in April, right on the onset of tariffs, and then moved back to a negative trend by August. Um, Again, if you look at this chart, it's just a bunch of chop. Really, the midpoint
Right.
of the last few years is around 4.3 to 4.4%. So we're a little bit below that, but inflation's come down, right? But it hasn't really. I think people were expecting more economic weakness at some points where rates would really start to head lower. So we'll see what happens there. I do think, they mentioned they're worried about the labor market. I think those concerns are pretty valid.
Right.
Whether you look at like other data or just anecdotally talking to people
Or no data, like we were
or no
mentioning.
data.
Right.
And
Yeah.
that kind of bridges us to one thing, I put a piece in the report about, yeah, I think, if you're going to buy insurance or going to buy puts, now is a really good time to do so going into next year. If you look at the VIX term structure, so looking at how vol's priced at further out on the curve, I think you're getting a relatively decent price for kind of the May to July timeframe next year if you wanted to institute some portfolio insurance. Um, I think you got a pretty good level on the S&P right around 6,500 or so, which there's some support right above that, but below that there's really not much, and that's about a 5% decline. So kind of hedging that 5% decline. And then the VIX is around its lowest levels for the year. So I think there's plenty of room for volatility expansion. The market has definitely slowed down its upwards kind of grind. Now we are close to all-time highs still, but it's been a kind of a choppy 4 or 5 months at this
Right.
point.
I think you made a couple good points in there. Obviously, I just want to focus on one of them. For those of you listening, obviously, as you move into your end of year client reviews, there's a couple of important things. One, you don't screw up the hard work that we've done in 2025, right? And so, you can go out. Maybe we have a couple weeks of chop here in 2025, but two, you're setting expectations for 2026. And so, again, when you can go out and buy some cheap, quote, insurance, that will set you, as you kind of have these year-end conversations with your clients, that'll set you out on the right foot. Just a nice touch point. Hey, we think markets could see a little bit of bounce, over the next 6 months or so. We can go out and actually hedge some of our positions that we've got big gains on that we don't necessarily want to go and sell at
Hmm.
the end of the year. So there's a lot of, conversational talking points that, you can, add to client conversations. I'm rambling a little bit, but
Yeah, and it
yeah,
may not be for every client,
yeah,
it's not something you have to do for everybody. But if somebody's like personally worried, like, okay, well, I need to have X, Y, X amount of money by the end of next year for some expenses or
yeah,
anything like
yeah,
that, I think like you're getting a pretty good price to protect that capital without having to create a big taxable event, like you
yeah.
mentioned.
In terms of looking at the PNF chart, for the VIX, right? I think we look the default is half a point, right? But we typically zoom out to a 1 point.
I usually just look at the 1 point.
Okay, yeah,
Um, it'll just move around too much on the default chart. Maybe we need to talk about changing the default scale
right,
on it.
yeah,
But yeah, on the 1 point, we're right around 16. The low for the years was 15.
right,
So we're pretty much right there. And I think when you're buying puts, not only is it hedging an actual decline in the market, but you're also kind of it's a long volatility position. So volatility kind of starts to
right.
grind higher too, for whatever reason, or shoots higher. You get additional protection there. That's what the convexity for options is all about. So I think not only are you getting a good time in the market from a price standpoint and the price action we've seen, but also just from a volatility standpoint as well.
Very good point. Other areas we were talking about before that rates impact, right? Do you want to take it to financials now? You want to go precious metals? Kind of a different conversation for each one. Financials slowing, precious metals really, continuing to move higher.
I mean, we can go with the precious metals to start out. I
All right.
know I know a lot of people are big on the precious metals.
Yeah.
I've seen a lot of talk about silver, breaking out above $60. I think it's at 62 now.
Yeah, very interesting. And maybe we can actually use this as the chart, but that what we call like the mint ratio or
Hmm.
the number of or the quantity of ounces of silver required to purchase an ounce of gold,
Yeah.
right? That has moved kind of back in favor. We don't necessarily think about it like a specific number, but we'll look at it on an RS relationship. So
Hmm.
I put a piece together, what was it, last week, talking about the potential for a return to a buy signal for SLV versus GLD. So we're just using ETF proxies here, right? But point is that since 2020, on a 3.25 scale, if you're pulling it up, since 2020, we've just seen back and forth chop, right? But ever since kind of before that, you look back into the early 2000s, largely speaking, this has been a very consistent RS chart. Now, again, recency bias says that this is not a consistent chart. But a return to a buy signal favoring silver, is certainly significant. You think silver is typically more industrial or useful when you're talking about economic expansion rather than gold, which would be more favored during times of uncertainty. So this is certainly notable development and gives us a good opportunity to talk about positive relative strength, which I'll let you have a go ahead if you've got thoughts and
No, no,
then it'll jump. Okay,
keep going.
positive relative strength, right? This idea that two assets are relatively strong, which one do you want to own, right? One asset can be up 10%, but another one is up 20%, right? You
Hmm.
want to own the one that is up 20%, right? And
Yeah.
so precious metals in general, very strong in 2025. Gold up, I think 60%, silver up over 100. Again, I think we want to own the one that's up 100, right?
Well, the crazy thing is too is gold kind of its favorability started to really decline right at the around the bottom of April. And since then, silver has just shot up.
Right.
I mean, June to now, the RS calculation went from, you know, under 10 to about 14. So like huge
Right.
outperformance from silver over that time period. We'll see if it can continue. Like you said, this chart has kind of been choppy over the last few years, but historically it's actually trended pretty well.
Yeah.
So we'll see what happens there.
And silver and gold, they've maybe been acting a little bit unlike their historical selves, which are a little bit less um, um, high octane is the word I always go to, but they've been moving around a little bit more, I think, than they historically have. But if you need some more juice, you can go look at the miners.
Mhm.
So there's a couple different ways that you can go and or risk spectrums that you can be on. The miners are going to move around a lot more than the physical metal itself, if that
Yeah,
makes sense.
yeah, for sure.
And the miners look good as well. So maybe a bit more overbought than the other items, but again, an option as well too.
hmm and that precious metals trend, either whether it's gold or silver, has just kind of continued to be the theme over the last year and a half or so.
Yeah.
Um,
Which is
so
good for momentum strategies following
yeah, I
that,
mean,
right?
any alt strategy that had a precious metals component in it, that was momentum based, is pretty much owned precious metals and avoided the rest of commodities,
Right.
which really haven't done as well. Copper started to pick up. Like you look at crude oil is, pretty much at its lowest level over the last few years. Natural gas has upticked, but that's kind of be expected as the cold weather comes in. It's pretty volatile this time of year.
Right.
So, I mean, precious metals, like within commodities, it's really the only place to be for consistent long-term relative strength.
Yeah.
Um, so I guess going over to financials, um, with the rate cut, usually that's fairly good for banks, right? Usually they can pay less on deposits,
Right.
while having their long-term liabilities kind of stay the same. Um, but one area where I've seen, financials itself as a broad sector has kind of weakened over the last couple of months, really mostly from a relative perspective. If you look like a broad sector fund like XLF, it's just traded sideways where the market's kind of grinded slightly higher. But payment processors have really started to kind of fall apart.
Hmm.
Now, some of the big names like American Express and MasterCard are still 5 for 5s and look pretty strong. MasterCard has given two sell signals close to a positive trend test. Really, the big one where you see weakness developing is Visa,
Hmm.
which is on 4 consecutive sell signals now, moved to a negative trend, reversed down on its RS chart versus the market. So it was a 5, dropped down to a 3 over the last month. Um, and really the first time it's been in a negative trend since 2022. It was really those, Visa, MasterCard were really consistent, kind of just chugging higher over the last couple of years, but we've seen some weakness there. And really, it first started developing some of the riskier, like the crypto payment
Yep.
processors, and then the buy now, pay laters, like Affirm, has
Call.
really,
Yeah.
yeah, those buy now, pay later firms have really fallen apart. So we'll see if that, I think it's one of those consumer stories, right? Everybody talks about the K-shaped economy, the buy now, pay later stuff. You know, people are using buy now, pay later, and then they're not paying it. They're literally just like defaulting on these
Yeah,
loans.
which is what you sent me a stat, or we were chatting about it in the office. Black Friday, like 95% of it was financed, right?
Yeah, and
But
like,
most of that's gonna be credit card, but then you've got like 10 or 15% of it through buy now, pay
yeah, I
later, and you're
think it was what 38%,
yeah.
we're using buy now, pay later
Yeah.
on it
And
or something like
and
that.
don't anticipate paying, or like 60% of them don't anticipate paying it back
Paying
in the next 30
30
days.
days. Yeah,
You're like,
just
oh, this is good.
yeah.
Uh,
So we'll see. I think, there's been a lot of talk about that kind of K-shaped recovery, whatever. Um, but I do think you're starting to see like that lower part of the K is starting to creep up and affect more like, middle class, where
right.
they're using Visa and MasterCard primarily. And those have started to kind of fall.
So I've got one question or maybe one comment and then a question for you. One, I'm, interested, obviously, like you said, the strength of the consumer is it's so important, right? And it's been
Hmm
a fallback for, any economic weakness that we've seen over the last couple of years. Well, the consumer's still strong. So that's fine, right? But if we start to see that kind of rollover. Maybe that's not
Well,
necessarily a good
that's
thing.
the interesting thing. Is like the consumer spending numbers are strong, but it's driven by a smaller and smaller subset
Right.
of consumers, which is like that's the K-shaped economy
And
type
where
of
that
thing.
spending is being put
Yeah.
is another thing. Maybe more from a technical perspective, though. I'm curious on your opinion. I get this question all of the time.
Hmm.
I get people say, okay, well, Visa doesn't look that good. Visa's fallen and lost technical favor, right? But maybe some other areas within the payment processors don't necessarily look as bad. Do you trim your Visa exposure to go pick up something else? Do you trim Visa entirely and hold that money on the sidelines, or do you trim it and put it in another sector? Three different options, maybe, or you do something else.
Yeah, I mean, I think for long-term holders of Visa, there's still a lot of support around 300 or 304. You could try to wait it out. I mean, I'd positive trend breaks. I mean, we've done a couple studies on this, and it's like if it's in a positive or negative trend are like the most indicative of kind of further performance moving forward. Um, in this case, I mean, for the payment processor space, at least, there's really not a lot of other places to go. The only one that looks really strong is American Express,
Right.
which I think gets back to the K-shaped recovery thing. Um, Now, I would you just say, just cut it and then go find whatever the best option is out there for you.
Right, right.
Whatever
Whatever it is.
sector it
Yeah,
is,
yeah,
or
yeah.
as long as if you have like half of it already in technology, you don't want any more technology, then just remove technology from the selection pool. But I wouldn't force yourself to say, okay, well, I'm selling Visa, I gotta go buy MasterCard or American Express.
Right. Okay.
I would open up the pool and see like, well, what's actually working right now? Where are some areas of strength, like emerging areas of strength? Um,
Or maybe you go finance the protection we were talking about
yeah,
earlier, right? I mean,
yeah.
there's a lot of different options. Obviously, it's going to be dependent client to client, but that was just something I get that question frequently when you
Mhm.
see something roll over. You're like, well, where do I put it now? And you're like, anywhere that looks good, right?
Yeah,
It's like there's a lot of things that
that
look
look
good.
good. Yeah.
So, anyways, that was my thought. We have another topic, or are we good?
I think we're good.
All right.
I think that's all we wanted to cover today.
Well, Joseph, I appreciate the time as always. I hope everyone listening and you listening, I appreciate the time as well. Hope everyone has a wonderful week, a safe week ahead, and we will be back again next time to touch on any developments.